Good day, traders. Can you hear me all right? Can you see my screen? Thank you. Thanks a ton for your responses. On behalf of NP Financials and Go Markets, I welcome you all to this step-by-step approach to pattern trading. I thank you all for taking time out from your otherwise busy timeline and for attending to this session. I am here to share my experience on pattern trading with Go Market clients so that you can understand and take steps to get started to use patterns as a trading tool. Alright, first thing first, please go through the general advice risk warning. NP Financials Pty Ltd advises all service recipients of the following. This information is provided only on a general advice basis and does not take into account your objectives, financial situation or needs. This webinar is only educational in nature. Let me give you some more time to go through the rest of this slide. Okay, now that you have gone through this general advice risk warning, let's move on. This discussion of pattern trading today will be approximately 45 minutes of duration. You may ask your questions anytime or at the end of each slide, or park your questions till the fag end of the discussion. Please raise your hand if you do not understand what I said. I'll be more than happy to explain it further. Please let me know if I speak too fast or too slow, or if you miss something which you want me to repeat. Please do not choose to suffer in silence. That's my favorite. Alright, so today I'm going to cover pattern trading history. Anything you need to use in future, you must know the history. So we'll go through it. Next I'll talk about must know professional patterns, what are they, and how you can also start using them after enough number of back testing after this webinar. How to identify the tradable patterns. There are many patterns which are probably low probability trades, like in a continuation at the top if you see a flag, similar thing, but you need to identify what are the high probability tradable patterns. I always try to look for high probability trades. I'll talk about bounce trades from Forex patterns, although these patterns can be used in shares as well, or indices, or bonds, or commodities. I'll also talk about breakout trades from Forex patterns, although the same can be used for shares, commodities, bonds, indices, other asset classes. I'll also show you how to put the take profit targets from your understanding of market price patterns. Next, I'll talk about the pros and cons of pattern trading, what not to do even if when you see a pattern, or what to do when you see a high probability tradable pattern. I'll conclude what I said discussed for last 45 minutes at the end of this webinar. I'll also talk about the competition details and our unique capital growth program, how NP Financials can help you. This is specially designed for Go Market clients. Okay, let me quickly start the ball rolling by posting a few simple questions so that you can get started knowing each other better. I'll post some 4 or 5 questions you need to answer. Who is trading professionally now? Yeah, thank you. Thanks for the response. Second one, who is trading part-time and work full-time? Yeah, most of you working 9 to 5 and then trying to trade breakout after drawing some trend lines. But we need to know which market are suitable for breakout trades at what time. That is extremely important. Is it London session? Is it European session? Is it overlapping of London and New York session? Is it Asian session? Is it overlapping of Asian with the European sessions? So different strategies, if you are an intraday trader, work a different time. Who is not ready to trade yet? Nothing wrong in this answering these questions. Be honest. There is always a first time to start. Who wants to learn to trade like the professional? Yay, everyone, all of our hand goes up. What is stopping you from trading consistently? So you may not, it may take some time, and write back to me at support@gomarkets.com.au. Now let's get started with the pattern trading history. Market tradable patterns are built on price plots. Probably you will find some repetition from my last market mapping, because this slide is the starting point. Who plots this price? Human behavior plots this price effect. And what constitutes a human behavior? Greed and fear builds human behavior. And is this human behavior consistent? Yes, the greed and fear behavior is consistent. Can we trade this consistency? Yes, trading patterns can be done taking advantage of this consistency. Can this consistency be repeated? Yes, the repetitiveness of the market patterns can be traded consistently if we see high probability pattern setups. Now, must know professional patterns to name them. You must know it. Without this, you must not start pattern trading. Tradable market patterns can be identified through double bottom or double top, followed by triple bottom, triple top, quadruple bottom or quadruple top, or queen bottom, queen top. But it all starts with class A double bottom or class B double bottom, class A double top or class B double top. I will show you how to define mathematically. Very simple. Head and shoulder, the normal to reverse the uptrend if it is properly defined. Otherwise, we can see an inverse head and shoulder at the right hand bottom of the screen. That is extremely important. Right hand bottom of the screen. It must not appear at middle of the screen or nowhere. Does not make any sense to me. Then I'll talk about flags and pennants as continuation patterns, be it in uptrend or downtrend. Then I'll introduce you to the different types of triangles: ascending, descending, ascending triangle in an uptrend, descending triangle in a downtrend, and so on and so forth. Which triangle patterns are continuation or which triangle patterns are reversal or wedge. Triangles can be actually loosely a subset of wedge. I'll show you. Now, how to identify these tradable patterns. First thing first, you must write it down and note it and remember for the rest of your trading life this slide number 7 of this webinar of Go Markets and NP Financials. Identify market patterns with the context. If there is no context, there is no market patterns, even if it is there. The context of a reversal, if it is a bearish trend, prior trend is bearish, you are looking for a double bottom. If the prior or inverse head and shoulder. If it is an uptrend, we are looking for a double top or triple top or quadruple top or queen top, whatever the market is showing us. I'll show you many examples. So context should be the demand and supply points or the support and resistance which you have identified and drawn. A market, Mr. Market, has respected those price levels. Extremely important. Now they must take place at the previous zones of demand or supply, as I told you. Demands are the support points, supply is the resistance zone. It's never a point or a line, it's a zone always, more often than not. Because crack and snap back can happen, fake outs rather than breakout can happen. Now the third is define the structure of the pattern mathematically. We need to define mathematically, which I will show you. How to calculate mathematically. You can do it. It's not rocket science. Now we need to identify an entry point. After we have identified the context with this zone of demand and supply, and we have defined the structure of the pattern, we are entering. We must place this stop. Must. The difference between a professional trader and an amateur traders are many, and one can be professionals always place stop after entering or at the time of entry, and amateurs avoid placing trades, hoping eventually it will go in their favor. The eventual time can be limitless or can be years or quarters or months or weeks or days. But you may not be solvent by that time. That is extremely important to put the stop loss. Calculate zone of take profit. I will show you mathematically how to calculate this. And you must book profit. When the profit is hit. Bounce trades from the market pattern. So here is the first one. Price either bounces or breaks out. I have never seen price doing anything other than bouncing from either Fibonacci levels or pivot levels or our previous support and demand or resistance and supply points, or breaks out. Like I showed you in my market mapping webinar of Go Markets and NP Financials, how to identify the breakout, eliminating the fake outs. Identification of bounce trade can be done through double bottom, triple bottom, quadruple bottom, queen bottom, U-type bottom. They have many names: flying saucer and cup and handle, and V. V is very rare, except after the recovery of the GFC in the indices market or the stock market. Or double top, or quadruple top, or queen top, or triple top, or triple bottom, as I showed you, or triple top. Those are the bounce trades. Now let's see an example. As I showed you, as I told you, I'll show you many examples. Hold on. Right, so first of all, I told you, if it is a bullish pattern, for example class A, double bottom in front of you, then it must appear after a downtrend. Why it is a downtrend? I told you in the previous market structure webinar of Go Markets and NP Financials and market mapping webinar last week. This is a downtrend. Why this is a downtrend? Because the peak, this is a peak because a down bar is preceded by an up bar, and this is a top because this is an up bar preceded by a down bar. Now this was a peak because this is a down bar preceded by an up bar. So the peaks are coming down and the drops are coming down or swing lows. So that's why it is a downtrend. Similarly, this first bottom at this point, the swing low, this is not a top actually, this is swing low because this is not an up bar, this is an inside bar or a bullish piercing, I think, in a candle. Till this point, so far so good. Price was making lower peaks and lower tops or swing lows. They are almost same, not exactly same, but loosely they can be said. Now the second bottom for a class A type of double bottoms must form or must print a new low in the form of a top or a swing low, doesn't matter. This second low, swing low or top, if it is lower than the first swing low or top, then this is a class A double bottom. So once we have seen, and between second, this is many things are extremely important here while we are defining. First thing is it must appear after a downtrend. That's what we saw in the second term and the third term, P star, T star, P, T, U, D. You remember all those things I told you already in the previous webinars. That's why these webinars are so priceless. And then second thing is this second bottom and the first bottom must be at least swing low. So this is swing low and this is swing low, because this low is lower than this and this low is lower than that, and similarly this low is lower than that and this low is pretty lower than the previous one. And in between this swing low, two lows, must we should have one peak or swing high. In this case we had a swing high because this is an outside bar, so this high is higher than the previous one and this high is higher than the next one. So between these two swing lows we must have a swing high. So these are the requirements: downtrend, support zone, and then class A is the second bottom is lower than the first bottom. There must be swing low and there must be a swing high in between the two swing lows. Now after we have seen all this, again I repeat, downtrend at the support. Previously we need to have a support. I can see some dot line on the support or the demand. Then we must see two swing lows. Either the second one is less than the first one, and then in between we have a swing high, and we need to draw a vertical line from this swing high in between swing high to the lowest low, not this one, not that one, the lowest low, so no lowest swing low. So this is the measurement 1. So this is the vertical line, measurement 1, and then we should copy this measurement 1 when price actually crosses this in between. I told you, very important, in between swing high. So our price objective is, if this is measurement 1, whatever pips it is, supposing it is 1 for roughly 45, this is roughly 37, so 800 pips, this should be 800 pips, 45 plus roughly 853, something like that. So this is our mathematical definition of the price objective and the mathematical definition of the double bottom. So we got a measurement 1. After this is actually closed above and the high taken out, we have a measurement 1 as a take profit, and now we can see a double top at this point. Okay, pretty simple. Next one, bounce trades from the market pattern double top. Now this is also class A because this was an uptrend, and the second top is the swing. I think this is a peak, and that is a peak because this down bar preceded by an up bar, this down bar preceded by an up bar. So this second top should be higher than the first top at the right hand side top corner of the screen when it is appearing at around 1.1. and then Aussie dollar, you remember, had a double top, and in between you should have at least one swing low or a top. This is a swing low, that is a swing low, this is a swing low, but we should take the measurement from the highest high to the lowest low. So this is the measurement 1, and after the cross of this we should get a target here which was achieved at this point 97. So this is a tradable high probability market pattern. Now the bounce trades from the market, this is unique, very good. Again Aussie dollar at 105. Market printed a class B double top. What is the difference between class B double top and class A double top? Class A double top, the second top should be higher than the first one, but in class B they are similar, not same. Life is not fair, get used to it. So this price pattern, price is also not fair, market is not fair, so get used to it. So that's why I say it is similar, never the same. It can be same dot, but very rare. So there are similar tops B class here, and in between this swing high and this peak, remember all the peaks are swing highs, but not the other way around. Not all swing highs are peaks. Similarly, all the troughs are swing lows, but not the other way around. Not all swing lows are troughs. So this is a peak, that is a swing high, so we can say swing high to swing high same, and in between we have a swing low. This is a must, otherwise this is incomplete, invalid pattern. As I told you, invalid trend line in my previous market mapping. So the measurement 1 here, when the price actually crossed by 1 pip, even that's fine, we got a measurement 1 here which reached here. Now after in between, price actually did not went straight down, it went up and then again formed a class double top, because the second high, swing high, actually this is a swing high and this is lower. The second high is higher than the first one, so this is class A, and the measurement 1 we have between swing low. So we drop a vertical line, we got a measurement 2 here which we reached here on this date. And again price went up, fantastic. We see a 1 2 3 4 5 6. So double top, triple top, quadruple top, queen top, I don't know what it is. After that, what we saw at the last one is actually a similar top which is a class B. Then in between this swing low, swing high and a swing high, we have a swing low. So we drop between this swing top to bottom, measurement 3, and the measurement 3 and measurement 1 are actually almost similar, and price actually reached here. So you got 1 target, 2 targets and 3 targets. How good is that? Just by defining a high probability tradable market pattern, as I am demonstrating in this Go Markets and NP Financials webinar, quality webinar. Now the breakout trades from the market patterns, those where the double top double bottom are the bounce trades, because they are bouncing from a demand line or a supply line or a support or resistance. This is a breakout trade because head and shoulder should appear. First of all, this is a normal head and shoulder which tends to actually break the uptrend. So what should happen? It should appear at the top right hand corner, and the highest swing high, this is the head, and right hand side this is the next swing high or a peak which is lower than the head. Similarly, on the left hand side we have a swing high which is lower than the head. Between the LS and H there should be a swing low, and between the H and the RS, right shoulder, we have a swing low. We should join this swing low to that swing low and take a vertical line from the head, this is measurement 1, and drop it after it breaks. So this is the break and we got a target here. Most important point is the HRS line must not be broken. Now this is a breakout trade, again an example of an inverse head and shoulder. So this inverse head and shoulder, this is a demonstration of the Japanese yen. So this lowest swing low was the head in a monthly chart in a right hand bottom corner, and then we have a swing low which is higher than this head, and then this we have a left hand swing low which is higher than this head. So we should join the H to RS, and we should identify between H head and LS, yeah, swing high, and head and RS, right shoulder, swing high. We should join the first swing high to the swing high, and this is actually measurement 1, and after it break this line, that's why it is a breakout pattern, and target was achieved here. This one and the previous one are all class A head and shoulder, because in this case this is a positive slope neckline and not a negative one, and the next one is also a positive slope because we are inversing, not a negative one. So if this high is higher than, if this high is higher than this, that will be a class B head and shoulder. You understand? Similarly, in the previous slide, if this slope is downward, so for example if this swing low is lower than this one, that will be a class B. Class A are always better. We saw class A double top, triple top, class B double top, and then class A head and shoulder, class B head and shoulder, class A inverse head and shoulder, and class B inverse head and shoulder. Okay, next. Alright, we observed that already. Examples of continuation price patterns, like a triangle. So this is an ascending triangle in an uptrend, which can be bullish because the peaks are going up and the drop are going up. This is a symmetrical triangle in an uptrend because the peaks or the swing highs coming down in an uptrend and the drops or swing lows are going up. So if you join peak to peak and swing low to swing low, which is this one, symmetric triangle is being formed and the breakout happens here. But if we join the peak to peak, because they are almost similar, or swing high to swing high, if there is no peak, because for peak the third bar has to be a down bar and the second bar has to be an up bar. For drop, the third bar has to be an up bar and the second bar has to be a down bar. So if that is not satisfied, then we have a swing low to swing low. Similarly, descending triangle in a downtrend, this is a downtrend because the P, T are coming down, P star, T star coming down, and here the top are actually stays the same, but the peaks are coming down in line with the trend. So this is a descending triangle, symmetric triangle in a downtrend when the tops or the swing lows are going up and the tops or the peaks or the swing highs are coming down. We join the peaks to the peak and then we join the top to the top. In this example I am saying peaks and top because this is a drawn example, not a market example, because this is down bar, this is down bar, this is up bar, this is up bar, this is so on and so forth. Yeah. Now examples of a continuation price patterns. Flags or pennants, they are actually continuation patterns here. So bullish flag in an uptrend, we saw this kind of double top here and then uptrend, and in this uptrend all of a sudden we saw the peaks or the swing high coming down and the tops and or swing low coming down, and they are forming parallel lines. When we join the peaks or the swing high to the swing high and the swing low to the swing low, and the measurement of the pole, P-O-L-E, is the distance between from this point to that point. When it breaks, we copy this measurement 1 to get the target. We can enter when this resistance is broken. Similarly, this is to the right hand side. We have a bearish flag in a downtrend. Why it is a downtrend? Because the tops were and the price and the peaks were coming down, and then we saw the top started going up and the peaks started going up, and we joined the peaks and the tops. We got parallel lines. We wait for the break of this support line. We entered here. Yeah, at this point. Okay. Now, almost all the high probability trade setups are in front of you. We need to remember the wedge, as I was telling you. A triangle is a subset of wedge. Wedge or falling wedge or a rising wedge can be a continuation pattern or a reversal pattern. Otherwise, bullish rectangle like this one is shown here are actually continuation pattern, and when the lines of the peaks and the troughs are not parallel, that becomes a pennant. We already talked about the double top and the measurement and head and shoulder measurements, so I'm not repeating that. I'll only concentrate here. A falling wedge is defined when the swing highs in an uptrend, when the swing highs all of a sudden start coming down and the swing lows or the troughs start coming down, and when we join the peaks to the peaks and the troughs to the trough, we see a falling wedge in an uptrend. So the falling wedge in an uptrend is actually a continuation, and we can have a target depending on the length of the pole. But a falling wedge at this here at this point here at the right and bottom corner of the screen is actually in a downtrend. Falling wedge in a downtrend is actually reversal. So it was downtrend, all of a sudden peaks were coming down and the troughs were coming down, and we join this, we get this type of falling wedge. We wait for this price to close above high taken out, and then we are in here with a stop loss below this red line and the target according to the pole. So the falling, remember, falling wedge in an uptrend is a continuation, falling wedge in downtrend is a reversal. Similarly, rising wedge in an uptrend at this point here generally is a reversal, because price was going up, all of a sudden peaks are going up, troughs are going up, but they are actually contained in a line, in two lines. So we should wait for the break here, and we enter here. Our stop loss would be here and target depending on the length of the pole. So rising wedge in an uptrend is a reversal. Rising wedge in a downtrend is actually a continuation. So it was a downtrend, all of a sudden we saw the peaks were coming going up and the troughs were going up, but they are contained in two lines in a triangle form, so we call a rising wedge. So we should wait for the break of the this here, enter here with the stop loss here, target is the length of the pole. So remember, rising wedge in an uptrend is a reversal, write it down, and rising wedge, same rising wedge in a downtrend is actually a continuation. Extremely important to remember. Moving on, I'll put together a prerequisite for any reversal pattern is the existence of a prior trend. This is extremely important. If we want to see a double bottom, we must see a downtrend. The first signal of an impending trend reversal is upon the break of an important trend line. Now you know the difference between a valid trend line and invalid trend line, a tentative trend line. An important trend line is a trend valid line which is drawn more preferably in a weekly or a monthly chart. When they are broken and a double bottom is formed, then it is a extremely important pattern. I'll show you live examples. The larger the pattern formation, the greater the subsequent move. So supposing a pattern formation like the one which I am going to show you is on Twitter. Let me show you that. If you go to NP Financials with an S at the end .com.au and go to our blog, which is this one here, click on there. and the first one you will see I have written on the 2nd of November, is share price of Twitter all set to move now. This is a monthly chart, and in between there are 114 weekly bars. So I have written share price of Twitter is all set to go if certain conditions are met now. The lowest low of the Twitter was at 1285 here, and the base formation has taken a long time, 114 weekly bars, my dear friend. So this is the head at the top, at the bottom left hand corner of the chart. This is the swing low, which is the right shoulder, and see how this is swing low, not a drop. Yeah, that's fine. This is a drop, that's fine. And this is the left hand shoulder. This is again a swing low, not a drop. In between the head and the left hand shoulder we saw a swing high, and between the head and the right hand shoulder we saw another swing high. We should take the highest one between these two. We join this to this, and our target would be that. Yeah, but certain conditions, as of I am saying again, certain condition has to be made. For to know this about certain conditions, actually you have to contact us, that you know. The larger the price I showed you, 114 is good enough. Similarly, Japanese yen happened 29 months. Top patterns are usually shorter in duration and more volatile than the bottom. The bottom Japanese yen were 75, 70. I showed you formed on 3 years. Twitter is forming 114 weekly bars, 2 years. The Aussie dollar I showed you formed in 1.1 only for 6 months, 6 bars. That's why I say top patterns are usually shorter in duration, more volatile than the bottom ones. Bottom patterns have smaller price range and take relatively longer to build. Now, offer only for the market clients. We are offering NP Financials is offering top class caring. Caring is the most important term I think in education. That's why at the top of this website you always see we care about your education. Yeah, this caring is so important. This is extremely important. Yeah. So we have basics of trading and one-on-one coaching, traders foundation, which are actually basics, and then you advance to the strategy based daily, 12-hourly and the 4-hourly. And if you want to develop patterns and code them mathematically I define, that is possible. We can help you in the custom coding. And if you want to scan the market patterns, double top, double bottom, and head and shoulder, and flag and pennant, and rising wedge in an uptrend, falling wedge, and so on in a downtrend, rising wedge in a downtrend, and falling wedge in an uptrend. We can help you on that to actually scan the market and develop our trading system around that. So for that, what you have to do, you have to go to our services section. For example, supposing you want to know what is a professional trader development, or what is a learn to code, what market scanning. So in the professional trader development, the duration will be 12 months. Otherwise, we have the advanced trading progression 9 months, mentorship program 6 months, and trader foundation 3 months. You can actually subscribe to get the alerts. Full-time professional trader from NP Financials will be your own personal coach for 12 months. You'll be introduced to our proprietary trading edges. It will give you 48 one-on-one coaching sessions. You will be attending 6 monthly seminars in addition to this 48 one-on-one coaching sessions. The 6 monthly seminars are actually 2 hours duration, happen every month of first Sunday, in which all the traders participate and discuss only trading ideas. You will get Traders Foundation, almost 600 pages of content. You will be coached to complete the weekly self-assessment task, which will allow you to move the next. And what we will cover there, of course, you can be an affiliate and earn money. These are the discipline strategy that is based. Popular strategies are designed for time-rich traders. Strategy capable of capturing early market reversals. This strategy will generate average 5 trades per week. Setups for 4 hour. This is the 12 hour and this is the 24. So this way, in a totality, we take 12 months to develop you as a trader by covering this and many much more. Alright, moving forward. Again, the special offer only for the Go Market clients. If you just want to start now, you can go to the market dynamics and mechanics. You can actually enroll there, or you can come to our monthly trader sessions and see what the other traders are doing. You can also map the market, the little bit of glimpse I showed you before in my last webinar, and this is extremely important. The demand supply trading, or the bar buy trading, or the market structure. So this was the one I was referring. When you become a member, you will come to know our not only the trade setups but also week commentary. So 4-hour trading model, 12-hour, and then 24-hour, and the asset class evaluation. So let's see one example of a 12-hour. What are the last month setups? We always capture these setups and discuss with everyone. Okay. So we not only mark them, we'll actually capture them and write them, and then you can have this months after months after months, and so on and so forth. Yeah. So we write how many setups we had, how many actually went and hit the target, and so on and so forth. Yeah. Similarly, we can have the 12-hour or the 4-hour, and so on and so forth. And in the instruction-based discussions, the 600 pages which I told you would be here, and then these are the basics of trading, commodity trading, 3 months trader foundation, and this is the one I am showing, 12-month professional trader development, which will cover the trader foundation, and the daily strategy, one module, 12-hourly strategy, one module. Each module would be for 3 months, and each again like this one here, 12-month professional trader development, module 1, 2, 3, 4, and we have units 1, 2, 3, 4, and under module 1, unit 1, we have 16 pages, as you can see. So that's what we go through. Yeah. So this is what we come to know. Alright, so this is we are giving actually very special discount to the Go Market clients when you enroll to our caring educational stuff. We always care. Trader competition, please why I say again harp on the caring attitude, because if you go to our home, you can see what the traders are saying. Partha Banerjee is extremely excellent Forex trader and trainer. He is a professional technical analyst who trades for living and sharing his professional trade secrets to fellow students during the advanced classes. So this was Trading Made Easy. Thanks. Partha, and Arvinder is writing, Partha deserves utmost praise and recognition for making trading so unique and yet so simple for novice traders like me and many others without the prior knowledge of Forex. So you can keep on reading, or you can go to our Google and then you can actually read what the traders are writing or giving feedback to us. Alright. Now let's go to the competition. Please provide your understanding and interpretation of how you can start your trading through our market patterns, which I discussed for the last 44 minutes. The winner will get 30 minutes mentoring session with me, which is valued $225. Please submit your entry at support@gomarkets.com.au. Let us stay connected. My name is Partha Banerjee. I am the principal trader of NP Financials, a proprietary trading firm. Our number is +61 is for Australia, for Victoria 95667275. Our website is nfifinancials.com.au. Our email address is info@nfifinancials.com.au. So you can start developing yourself as a professional trader by taking advantage of our caring educational discipline approach, and take advantage of our tailor-made professional services. As I showed you, why it is tailor-made, because if you want to scan, it is there. If you want to code, it is there. If you want to strategy, it is there. If you want to do a foundation, it is there. Everything is there, because we trade, we do nothing else. A very big thank you and happy trading in the market patterns. Thank you. Good luck. Bye for now.